joined by partners at some of the bigger players in early stage VC investment in this region. Our speakers include Sérgio Massano, partner at Antler, a company builder founded in Singapore just in 2018, but it's had rapid growth globally since then. Most of you have probably already heard of it. Also Vishal Harnal, who is the general partner at 500 Startups. It's the most active global VC firm by deal count and exits. Its portfolio includes Grab, Bukalapak, Udemy, and Canva. And finally, Michael Blakey, managing partner at Cocoon Capital, which is a large Southeast Asia-focused VC, which also happens to have many job openings for insiders at its portfolio companies. So we'll start this session off similar to the last one. I'd have the three speakers introduce yourselves and just tell us a little bit about your company more than I was able to, and what excites you most about doing business in this region. So why don't we start out with Michael?
Hi, thank you very much, Nick, for your kind introduction. So my name's Michael Blakey, co-founder of and managing partner of Cocoon Capital. We're an early stage seed fund with a mandate to invest in deep tech and enterprise tech seed companies throughout Southeast Asia. We're 4 years old and been around, or we have around 35 million under management. We're on our second fund, which we've in year 2 of, so we're still actively investing. We do very few deals, but we go get very actively in terms of supporting them, and we're always the lead investor.
Great. How about Vishal?
Hey, sorry about that. Hi, my name's Vishal. I'm a general partner at 500. I run the 500 Startups funds that invest all across Southeast Asia. We call them the 500 Durians funds. 500 is a firm that is now a decade old. We've invested in over 2,500 early stage companies across 70 different countries. We have over 20 funds that have invested in perhaps every corner of the planet so far, and we continue to expand that. My funds, the 500 Durians funds that we run all across Southeast Asia, invest primarily at the seed stage. We are a fairly traditional seed stage venture capital player. Our average ticket size is about $500,000, 300 to 500,000 US dollars on our entry ticket. We double down on the companies that are successful, and then opportunistically do large investments, $20 million special purpose vehicles and things of the sort when we see good opportunity. What separates us from a lot of the other venture capital firms out there are two things. The first is that our thesis is fundamentally a thesis of investing in a diverse portfolio. So each of our funds has at least 100 investments, and we think that that's a good way to sort of like offset the risk of venture. The second is that in addition to doing venture capital funds, the core of the business and the core of the philosophy of the firm really is to build emerging venture ecosystems all across the world. So we have a funds business, but we also have a partnerships, government partnerships, revenue generating business that works with corporates, governments, education institutions all across the world to build fully baked out venture ecosystems globally.
Amazing. I'll have Sergio close it out now.
Hi, everyone. My name is Sérgio Massano. I'm a partner on the global partners at Antler. I'm also the head of expansion, which means that I'm responsible for the opening of funds in new markets. Antler is an early stage investor, and I guess in a similar stage as both Vishal and Michael have talked about. We're now responsible or present in 14 different ecosystems in the 6 continents. We have a little bit over 200 companies in our portfolio, although we were just born a few years ago, 4 years ago to be precise. And I guess the biggest difference between us and a few other funds is that we really do come from the 0 to 1, as in the sense that we try to find our deal flow generation, which is, we'll talk about it, one of the most fundamental parts to venture capital. We try to bring in and reach the entrepreneurs at the stage where they don't have a company or they don't have a fully formed idea, and support them from scratch. And we operate across the planet.
Great. So the next question I want to ask is related to what you just all said. I think VC is a large space and it's a bit complicated, and all three of your firms have grown really quickly and done really well. But I think while people know what VC is, they may be a bit confused by what individual firms do. And so the next question I'll ask is, what common misconceptions do people have about what you do, and what do you actually do to answer that question? And so I'll have Michael start again.
I think a lot of people, when they talk to VCs, they just see us as people who are giving them money, and you know, that's all our goal is we give money and then we just move on. I think, you know, there's definitely within the marketplace a big difference between what I would term smart money and dumb money. And smart money is, you know, if you talk to like 500 startups, their network is phenomenal. What they can bring in terms of the learnings and everything from other businesses, and what they've seen can actually massively improve the chances of success for the companies. Myself and my business partner are very operational. So we've done startups and built startups ourselves, and I've been in, you know, doing this for over 20 years now, and my partner's been doing it for 25 years. So what we can understand is we've seen many different types of businesses. We've seen many of the mistakes that they've made. So helping founders avoid the common mistakes, improving their chances of success, I think is very, very important to us. So I think that's where I think the biggest misconception for us is we're not, the good VCs are not just about the money. Actually, to be quite honest, that should be the secondary consideration to why you know would accept, if you're an entrepreneur, you would accept money from a VC. It should be what else do they bring alongside the money, and that's the most important side.
Definitely smart money versus dumb money. So next, Vishal can go.
That's very kind, Mike. Michael's a good friend. I just saw him a couple of weeks back. You know, the ecosystem tends to be a lot more collaborative than people think. And I think just a week after I saw Michael, I actually met Dmitry at another sort of like drinks events that we had right after that. What are the things, common misconceptions that we have? I think to me at least, the biggest misconception is that venture is all about really smart people picking winners, winning companies. So investors have this magic skill of picking the winning investment, the one that's going to hit $1 billion, the unicorns of the future. And I think what people don't understand is how much luck has a role to play in picking those companies that eventually become really large. It's very easy on hindsight, once you're in a company that has hit $1 billion, to look back and say, oh, that looked obvious. Yeah, of course, I had the magic touch. But no one talks about the lemons in the portfolio that you hit along the way to getting those one or two investments that end up being wildly successful. So I think there's a skill aspect of it in terms of reducing the risk of failure, or alternatively, increasing the risk of, or increasing the chances of investing in a successful company. But there's a very large role that's played with luck and trying to find a way to offset a huge amount of uncertainty that exists in venture.
Sure, I think especially with the early stage, a lot of it definitely comes down to luck. And finally, I'll have Sergio and give his opinion.
Yeah, I completely agree with what has been said. So let me give you a different angle, which is people forget that VC is a hyper-local business model. And we always think about venture capital as in other asset classes as something which is transportable and that exists in different regions. But a great VC in one specific region will struggle to find the deal flow that will make him that kind of winner in another region. So when it comes to VCs, your expertise, your geographical knowledge, your understanding of markets, your understanding of trends, it's actually far superior, or it's far more relevant than you'd see in other asset classes. Because when you're trying to predict the winners of the future, like it was just said, luck plays a big part in it, but you do need to understand what's the underlying what's the underlying behaviors of the population or of the corporate ecosystem. So trying to understand that every single VC, besides having knowledge in sectors, in stages, in areas, a lot of their understanding, a lot of their ability to really read into what the future looks like and to do the right investments has to do with that specific hyperlocal and geographical knowledge.
Definitely, knowing about local knowledge is very important, and it leads me to the next question, which is focusing on these emerging markets, which our club is all about, and where most of your investments are. These are often developing countries, and they're changing, and VC itself is a game of allowing startups to take that step from 0 to 1, and luckily, hopefully, one will become a unicorn. But my question is more about the economic development of these developing countries and what role you see VC playing in it, and if any, if that's part of your consideration. So I'll let Vishal start with this again.
Maybe another way to think about it is that rather than, and I don't mean to not answer the question that you're posing, but maybe another way to look at it is that what is the role that startups and entrepreneurship play in emerging markets? And VCs are part of that larger ecosystem. And the way I'd say it is this: technology, capital, expertise, those three things coming together has a phenomenal power to bridge the gap between developing, least developed, and developed countries. You don't need to go through decades of pain of advancement to get to where more developed countries are now, because you can utilize technology, you can utilize entrepreneurship to make that happen. I think it falls along a trend of self-sufficiency. It falls along a trend of self-determinism, and which is one of the reasons why we focus a lot on emerging markets, right? We have funds for Latin America, for the Middle East. We have one even in Turkey and Turkic countries, specifically for these reasons. It's that when you have a sort of like a inflection point in an ecosystem, which is when young people in particular want to become entrepreneurs, the rate of advancement and development that a country can go through and the birthing of very large billion-dollar outcomes can be quite tremendous. It's something we've seen in Indonesia. It's something you're seeing in Vietnam. And as Dimitri had said earlier, Malaysia has been for a long time now birthing companies that become very largely successful and then quite quietly move to Singapore. But it's happening all over the world, that larger narrative.
Definitely. So I know Michael has some companies that are doing interesting things in these countries, so I'd love to hear his thoughts on this as well.
Yeah, I mean, at Cocoon, we take it quite seriously, actually doing a lot of education. Just following on from Vishal's point, though, I totally agree. We can't just look at it at a VC side, but I think especially with technology, when I first started investing back in 2000, to do a startup, you needed about 5 to 10 million pounds. Now, through AWS and a lot of other services, entrepreneurism is opened up to anybody and everybody. You don't need to be a 35-year-old who's made his money doing something else, but it can be it can be somebody who's learned to code by themselves, who's dropped out of school. Anybody can actually start a business anywhere in the region. The problem is, and VCs are not looking just for good businesses. We're looking for the outliers. We're looking for exceptional businesses. So where VCs come in is we've got to help a lot of these local founders, especially if you look in Southeast Asia. Many founders I meet are not well traveled, so it's hard to see for them to think quite often outside of their home market. But for a VC to invest in a company, there's very few sectors where you can say you can just do this one thing in one country and not ever expand it. We're always looking for something that can be expanded into other markets. So part of what we have to do is sometimes actually work with founders and actually help them understand what is going on in the bigger world, which they might not be. And also a lot of people don't have a formal education. So you get founders, especially a lot of founders are more on the tech side. So they don't know how to build a business. They don't know how to scale it. how to, you know, find the product market fit, do the revenue, or any of these other parts of running a business. So at Cocoon, we spend a huge amount of time on the education, helping them actually find. That means we're running office hours, workshops across the region, from like Myanmar, Cambodia, all the way over to the Philippines. But it's got to start with the founders first, and then the money will follow. Money will always find good investments, but just because there is money doesn't mean that there's good opportunities there.
Great. And finally, I'm sure Sergio has a lot to say about what Antler is doing in all of these countries.
Yeah, I think we all always need to think about technology and answering kind of on the broader side more than PE or VC, right? Technology is both incredibly deflationary, uses common skills very quickly, and uses common and open infrastructure. And normally, this is an infrastructure which is above each country, so it's at a global level with things like AWS or others. So you're not only running on so for countries with emerging markets, which normally the struggle has a lot to do with the ability to invest, the ability to have something that works, a structure or an infrastructure that is reliable in the long run. Technology plays a massive part in there. And when we're seeing a lot of our startups is, first of all, they're actually able to survive in harsher conditions. The second one is when it comes to emerging markets, because there was not an evolution the same way that you see in many developed economies, you don't have regulation that in many cases stifles innovation, right? If you try to open, and we're seeing this in the this new COVID world in which health, education, and others are coming into play. And what we're seeing, across Antler is that the fact that in some of the emerging markets, there is not a strong presence of, let's say, hospital networks or even doctors or even a centralized schooling system that allows for, new platforms to come up. So you have the best of a global world with platforms which are, or with a infrastructure which is global, and the best of local players. And that's kind of the last one, which is there's still the ability to launch local winners. The beauty of emerging markets is that they are very specific and they have a lot of issues to be solved. So there's not a simple solution to these. It involves a lot of local knowledge. So the technology, the way we're seeing it today and the way we're probably going to see in the next couple of years, has really created, in essence, the sandboxes and the tools that allow, with little knowledge, or with knowledge which is quite dispersed throughout the internet or throughout programs like Antlers, it allows you to build from scratch with little capital platforms which can be local winners on a very reliable infrastructure and actually be a quick winner of a market that didn't exist before.
Great. So before I go to the next question, I just want to let the audience know that we are going to open it up for a Q&A before the session is over. So if you do have any questions, feel free to put them in the chat, and then I'll ask them later on. But before that, just so people get a better idea of what each of your firms do, because even though you're all focused on early stage investments, you do have slightly different models in the ways that you offer support to startups. So if you can just briefly go and explain what's different about your firm versus the other people on this call and other VCs in general. And again, we can start with Vishal on this one.
I hate going first. So it's,
I'll remember that in the future.
No, I'm kidding. I'm just being facetious. I'm gonna just give a little bit of backdrop to this question, which is when I started investing about 6 years ago, I was completely new to venture. Venture didn't really exist very much in any large degree in Southeast Asia at that point in time. There was, in a handful of rooms, you could, in a small room, you could have every single investor sort of like in a small space having drinks with each other at that point in time. But one of the things that I noticed, at least about what we were doing back then, is that we were trying to do everything for everyone, which is we were trying to help them out with hiring, we were trying to help them out with strategy, we were trying to help them out with building the business, we were trying to help them out with product, trying to help them, plug gaps in the entirety of the ecosystem with fundraising, all sorts of things. And especially for the approach that we take, which is to invest in 120 companies, it becomes a little bit hard to do that and to actually be really valuable partners to the companies that we invest in by being so general. So the approach that we've taken for many years is to focus on a few things, but do them really, really well. So if I could burn everything we did to the ground and keep one thing, and this is the thing that we focus all of our attention on, it's really fundraising for our portfolio companies. The reason that we honed on to this, and this may seem a little bit odd more than anything else, is that if the company does not raise another round of capital, the company dies and the fund doesn't perform with it. It's very rare for a seed stage company to become self-sufficient on one round of capital. So we said, why don't we build a team? Why don't we build expertise? Why don't we build infrastructure to allow our portfolio to raise at scale? It helps us, it helps them in a very, very big way. And our portfolio companies seem very, very thankful for that. And it shows itself in the percentage of the portfolio that actually raises another round of capital. So we measure that result and see how it pans out. The second thing that we do is that we try and find real ways to make use of the very wide network that we have. So if you think about it, it sounds really huge, right? 2,500 companies, 70 different countries, co-investors, corporates, governments, all of these things all around the world. But unless you have a way for the startups to navigate that space and make use of those relationships and tap into them, it's not as valuable. So we've developed over the years a platform that allows us to understand which one of the relationships is most useful to the companies and make those introductions for the companies at scale when they need to leverage on the value of the network. The last thing I'd say is this. We are not around for every single thing that happens in the day-to-day of the companies, and we make that expectation known to the founders of the companies that we invest in. But what my partner and I at least make sure is that the few times, and it happens few times in a year, or perhaps over the course of a couple of years, that there are crucial conversations that need to take place. There's an existential event in the company, a big decision, big strategic decision needs to be made. We make ourselves available and lend our expertise in those few times. So that's how we help our companies out.
Great, and I'll have Sergio go second this time.
Yeah, I think in Antler's case, I would reduce it to a few words. The first one is optionality, right? Our model is based around the fact that you as a founder or you as a team, you starting a product or you already with some traction can come into any of our local funds. You can have the support before even we invest in, because we bring in founders, we help them for 10 to 12 weeks, and then that's when we make our investment decision. And then after that, so during that period, you're able to pretty much pivot from an AI to a direct-to-consumer brand to whatever you feel like. So one of the first key elements of this is you're able to come in and really work on the problem that has your passion, has your drive. And once you start working on it, you feel that there's the path forward. So optionality is retained at the business model level. Optionality is retained at the geographical level. Our companies are able to, from the moment that we invest in, move across to any geographies. And across the multiple geographies where we have, they're all focusing on the same stage of company. So the opening of doors either to customers, to other funds, to just simple admin and incorporation, that's already there. And the last one, you have a massive optionality when it comes to who you're gonna having sitting next to you on this ride. Because of our batch system, when you're joining 100 people in a very similar way to INSEAD, in which you don't really question the quality of the person next to you. Just wonder, do I want to work with this person? And are they my peer for this trip, right? So that optionality of finding the right people, having a very open and frank conversation. And not only that, after Antler's investment, having a pool of other people who are your classmates that are able to join as first employees, that are able to open doors later stages, that makes a big difference. And if you think that we have right now in parallel, something like 600 to 1,000 people every 6 months across the globe doing this, it's a massive alumni network that is only growing and only going to be more valuable in the future.
Amazing. Finally, Michael can go.
I always like being contrary, and I think at Cocoon we're very contrary. We take a very dissimilar approach to the other two funds. What we do is we focus. So we actually put very few eggs in a very, very small basket. So our approach is that we only invest in 4 to 5 companies a year. And then we actively support those businesses from fundraising, from business strategy, not getting involved in the day-to-day, but very much working with the founders to educate them in terms of having them understand what are the different options on their table. And we're very much focused on the first 2 years, building the founders into a good CEO, a good CTO, building the foundations for those companies. Both Will and I, before we set up Cocoon, were both angel investors. And during that time, it's a model that we actually both took individually. We didn't know each other until 2015. And with that, we achieved both of us achieved over 50% success rate, an IRR of just about 45%. And for me, that's over a 20-year period. And I think it is because a lot of great companies, great founders, because their first time building a business, there's a lot of, and even at INSEAD, a lot of you are not taught, you look more of the corporate structure than a startup structure. So there's a lot of things that you don't know about building a business from scratch. And quite often, because money is tight, one mistake and you fail. We try and avoid that. So we improve the chances of the success of the people that we invest in. Doesn't mean we'll always get it right, because as Vishal said correctly earlier on, there is always an element of luck. But we try and reduce the average success rate of a kind of a VC-backed deal, which is maybe about 5%, and we're aiming for like a 50% success rate. But the risk is can we pick the right companies to invest in? And that's, that I think we've proven it now in terms of the companies, but it is a much riskier approach to take. So it is not one that is common for VCs to take. That they are much more invest in a much larger portfolio and then back the winners, double down on the winners. As I said, with Contrary, and in a few years' time, we'll be proven if we're right or wrong to take this approach. But the great thing with the VC models, there isn't one right way of doing it. I think it like when we're investing in a startup, we look at the people. I think it comes down more to the people running the funds than necessarily the approaches or the brand that the funds have or how much money they have.
Great. And so in the last call, we spent a lot of time talking about the difficulties of fundraising during COVID and portfolio companies not having enough runway and so on. And I guess since your funds are a bit different than the ones on the last call, I'd be curious to see how COVID has impacted your business, and also if there are any interesting trends that you've seen this year, if there's anything that excites you or anything you're scared of. So this time I'll have Michael continue and go first.
For us at Cocoon, this has actually been our busiest year that we've ever had. And I think a lot of it is because a lot of the other funds have had to slow down their investing whilst they support their current portfolio. And also due to the uncertainty of the world around them. I've been around, sadly, I started before the dot-com boom and bust time. So I know that actually some of the best companies are built during these tough times. I think the trends that I'm seeing is I'm seeing a lot more enterprise tech. When I first moved to Asia in 2013, I would say the bulk of what I saw was more B2C. In terms of enterprise tech now, I'm seeing a lot more industries realizing that post-COVID, they're going to have to run more efficiently. The world is going to change how people move, how people work. And the only way that you can actually stay relevant within these industries is to look at digitizing. And that could be the travel, the hospitality, to F&B, to pretty much any business really, is looking at that way. So I'm seeing a massive rise now in what I would say enterprise tech. In terms of doing deal flow and sort of, raising the funds, I must admit, I'm still old school. I find it really hard to invest in people that I've not met. With only now doing our first deal where I've not met in person the founders, and to be quite honest, I am struggling. I'm probably doing about 3-4 more times reference checks and kind of doubting myself more than I would have if I could actually sit down in the room, meet them, meet the team, talk to customers face to face. So I'll be interested if this continues, the lockdown, in terms of inability to actually travel. I will be interested to see more how next year looks in terms of the pipeline of deals that we end up closing.
Great, very interesting. Sergio can go next.
Yeah, I think we are from a change. We're seeing a lot more and a lot better talent in the markets, right? The quality, the availability of entrepreneurs has just skyrocketed, either because they're leaving jobs, they're finishing MBAs, or because they were in hyper growth companies and R&D types of developments or areas which are not as prominent today. So you're seeing really, really strong quality there. From a company standpoint, we're seeing a lot more focus on long-term growth and metrics. So this idea of growth at any cost has stopped a bit. We're seeing also trends which over the last few months we've seen, which started as kind of a put stop. Now it's an actual trend, right? We're seeing generational shifts happening in multiple areas. I think health that I talked about earlier and education are clear, but most of all, we're seeing the digitization of SMEs. And that is something that once it's in place, it's going to be pretty hard to go back. And I think that's, I guess, like Michael said, I guess that's the most interesting thing, which is if we think about this pandemic as something which will last probably 1.5 years from stop to finish, this means that in 1.5 years time, no company is able to survive unless they actually move to a new model. So what's going to come out of this is companies that they only survive because they're digital. They've only survived because they are different. And that's going to create this whole cluster of new companies, of new businesses. That's just going to be one order of magnitude. That's going to come to the market 1 order of magnitude faster than we thought possible.
Yeah, and Vishal can go next.
So I'll start by saying how it's affected us and then the ecosystem and the companies in general. Pre-COVID, my partner and I spent about 6 to 7 months of the year traveling. So we were very used to operating remotely even before the pandemic. And quite contrary to Michael and most investors, we've probably done most of our investments. And I think the two of us have invested in about 250 or 260 companies without necessarily meeting the entrepreneurs in person for the most part, for a majority of the portfolio companies. And that's, I think, part of it is a nature of investing at seed and sort of like focusing on what we think we really need to know about the companies before making an investment decision and sort of like optimizing something for speed, valuation, things like that. So in terms of an adjustment to how we've been doing business, like in general, it's been minimal for us because we've been used to this medium of doing deals. I think our team is just a little bit sick and tired of having us in the country at all points in time. And so they're a bit fatigued. But besides that, in the way that we've been doing deals, it's been quite similar. The second thing I'd say is this, like if you think about investors, like many people have asked us, has the ecosystem slowed down? Why aren't deals getting done at the same pace? Venture activity seems to be slowing. What's going on? Investors and people that operate in the startup ecosystem are human beings too, like in any other industry. And what that means is when a pandemic hits in March or April, the first thing that you're going to look at is your own psychological safety and those of your loved ones. You're going to make sure that you are safe, your families are safe. If you have kids that, they're taken out of school, whatever arrangements need to be made to ensure that you and your families are safe. So that takes us March, April, a little bit of May. Then you're going to start securing the business as it operates. Are your companies doing fine? Are your teams okay? Is the firm ready to ride out the longer haul of COVID if it lasts for a longer period of time? And once those things are settled, you then start saying, okay, now what are the opportunities going forward? Let's start investing actively again. During this period, I think we've been investing at a fairly active rate. So we're doing about 2 deals every month, 2 new investments on a monthly basis over here in Southeast Asia. And many of the things that we've seen are follow trends that both Michael and Sergio spoke about. So let me give you a real example that serves as a microcosm of this. This conference, the INSEAD Emerging Markets Conference that we're having right now over Zoom, or the PEVC conference that took place a few weeks ago, or the countless other conferences that have taken place in Singapore virtually, would never have taken place virtually unless there was a forcing function. And that's happening to meetings. That's happening to the way business is done and being conducted, with the way consumers interact with suppliers of various goods and products that they need, how businesses interact with their business contacts and their suppliers, and it's rippling all across the world and all across the ecosystem. What unifies it with venture is this. If you think about venture as an asset class, it tends to be more biased towards technology. You're more likely than not to be investing in companies that are solving problems of inefficiency, and inefficiency usually means an overwhelming amount of human contact. It's in the direction of digitization. It's in the direction of technological solutions to problems. And so at large, venture as an asset class benefits from something that pushes people towards solutions like this. And that's exactly what we're seeing with the companies. So it may not be that every single company benefits from it. There's certainly sectors that aren't participating well, and companies that should have been dead a long time ago are starting to meet their demise. But for the large part, the trends are pushing things towards digitization and the adoption of new technologies that otherwise would have required a much longer sales process and time for buy-in.
Yeah, definitely a very interesting time with a lot of forcing functions going on. We are out of time now. If you guys are willing to stay on a bit longer, we do have a couple of questions from the audience on more practical advice for MBAs who may be considering VC or entrepreneurship right now. But if
fine with me,
you need to go, totally fine.
Yeah,
fine with
sure.
me. I'm happy to stand a bit.
Yeah,
great. So the first question is, from a VC perspective, does having a top MBA degree help an aspiring entrepreneur to a significant extent? Are these individuals more likely to secure VC funding? And Michael can go first.
Oh, crap. I'm gonna get into trouble for this one. Okay. I think I've invested in a number of MBA students over the years. And I've had more. I haven't had such a great success with that model because I think MBA students tend to overthink things, and they want to do modeling, they want to do this rather than go with their gut reaction. And everybody talks, oh, we've got to, the whole consultancy speak, think outside the box. All the great founders I've ever met never even recognize the box in the first place, so there's no thinking outside of anything. What I have found, though, is an MBA student that comes in to a company that has already got, who's got that early traction, and they need to actually scale. That's when they really do come to the fore. The one thing that I have found with MBA students, though, is they're normally very good at fundraising because they get actually how to talk to investors. So a lot of the founders that I speak to, especially those that don't really come from a formal background, the traditional approach is they come and pitch to you their product and their idea, and they don't really understand how even a VC works and makes money. So they don't actually, as I always say, a great salesperson always knows who they're selling to. When you're selling to an investor, you're telling them how you're going to make money and how they'll make money, which is a very different conversation that you would have with a customer. So so again, it comes down to the point is also it's about relationships. So if you can build a relationship with an investor, then yes. But I've got to say, if the MBA students here are thinking, okay, we want to start a business, sometimes actually forget some of the stuff that they've taught you at INSEAD. You can't, most of the time there isn't an answer, and you just got to go with your best guess and just hope. And I always say over-analyst paralysis is what I sometimes see with MBA students when they're right at the start of doing of that journey. I knew I was going to get in trouble for that.
Very good advice. Now I'll switch to Sergio. I think that it would be pretty interesting to hear his response, because a lot of INSEADers probably are considering the Antler program after graduation. So
Yeah,
I'd love to hear what you have to say.
yeah. I think an MBA, when you're starting something of your own, an MBA is a toolkit and not a status, and that's a fundamental difference for us. You know, I was where you are today, applying to jobs, and you know, you're a post MBA associate, you're this, you're that, and that's a status. If you're an entrepreneur, no one really cares about your status, right? It doesn't matter. So if you think about your MBA experience and everything that you learn as another part of your toolkit that you didn't have before, which complements your experience the same way that something else would do, that's a perfect thing. If you think that just because you have an MBA, you will be able to get funding, that's a very different concept. Now, like Michael was saying, it is true. You need to get, like when you're selling to anyone, when you get into a room, what you need to be able to do is to talk the language of the person that's sitting across the table from you. So most of you will have a lot more in common with a VC from a background, from an age, even from an experience type of angle than some other VC, some other entrepreneurs which don't have it. But that's just something that gets you into the room. It doesn't really matter if you don't deliver the results. It doesn't even matter if you don't understand who you're talking to, and if you don't adapt. And especially, and we see this in some cases, if you think that, you know, just the stamp will actually be a plus per se, that's in the normal working world, entrepreneurship is very, very different.
Great. And finally, Vishal can go.
So I'm just thinking in my head, because the portfolio is large enough that I can draw some sort of like statistically significant correlations in success in MBAs. And I'm just thinking that there's no correlation, at least from what I can think, between people who have MBAs and the large successful outcomes in the portfolio. But I would say this, right, which is maybe a question to ask yourselves if you are doing an MBA is, what were the skills that you were looking at picking up? Is it about company building and taking risk? Is it about signaling? And if it's signaling to whom? I think it may have been more of a thing some time ago in the Valley and perhaps in the early days of the ecosystem over here. But now there are just so many other things that you can look at as indicators of success that you don't necessarily have to look at a postgraduate degree or a top MBA degree to determine whether you want to take a risk. I would say, though, that if you are pre-product idea back of the napkin and you want to raise your first round of angel funding from someone, perhaps it's useful in getting that done. Perhaps when you don't have any proof points, having a good degree from a place may just increase your chances of being able to raise that very, 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 very first round of funding. But I say that with no data or information in front of me. So
Yeah, definitely.
Can I just hop in here and do a little pitch? So you mentioned earlier that you know, we are doing a lot of recruitment through INSEAD, and you're kindly helping us on that. That is made a lot of the time is because we've invested in some very good companies, and the founders have taken it to a stage where probably you need somebody with who can come in and can actually then take the data points and actually build a team and actually grow it to either a regional or global player, because a lot of the founders, they're much better at the early nitty-gritty, getting the product there, having the vision, but maybe, and a lot of them aren't even interested really in actually taking it to the next step. So that's one of the things that I would say when MBA really does come in, and we're getting in with VCs is a great thing, because I think Vishal and you would say that a lot of times, you know, a lot of founders struggle to find good people to come in and help take the companies to the next level. It's not just about the money. A lot of it is to do with getting that talent early on.
yeah, I agree with that.
Great. And then the second question that he asked is, for someone who wants to raise seed funding for a social impact business, are VC funds the right place to do so, given that the return may not be as attractive, might take much longer? And we can go in the same order. So Michael can start with this one.
No, there's There's impact funds, go after them, be brutally honest. We you know, our business is, what we promised to our LPs is outsized returns within a 10-year period. But I find a lot of companies which are doing like social impact and everything, sometimes you just get rid of the social, they're still an impact, and you say that they're still good businesses that to invest in, and that they do good is great. It makes everybody feel better, but sell the business, don't go purely. But there are impact funds that will focus on those type of businesses. Really, that's the best route to go after.
Yeah, and just to add to that, we do have a session on impact investing tomorrow, so come back for that and we can talk more about it. But I'll have Sergio and Vishal follow up.
Yeah, very quickly, I agree. Find the fund that's right for you. If you're doing impact, go for an impact fund.
So again, agree with the both of them. But one of the questions that you should ask is, and I think we're seeing this happen a lot more often, is that actually mutually exclusive? Does a business that has impact or social impact necessarily need to be devoid of venture returns, right? I think one of the questions is how do you measure it, and how big do you want to grow it, and what type of business do you want to grow? And if it looks in the larger scale like being a business that is capable of delivering venture returns, even if it seems to be touching on social impact on that space, then perhaps you could still approach the traditional venture players. But if it isn't, and the purpose of the business isn't to develop, build a unicorn or a multi-billion-dollar company, then perhaps you should approach other funds that have that mandate.
Great, and I have one final question before we end today. We spoke about this in the last session, but I was wondering if there's any different advice here, given the different types of funds that all of you are running. What practical advice do you have for MBAs who are looking to get into VC? And even if it's not directly getting a job in VC, some of the past panelists mentioned working for a portfolio company. If that is the path you take, how would you make the most of it? And then how would you use it to navigate your path into working for a VC like the ones that you are part of? And we can have Sergio first on this one.
Yeah. Well, first of all, and I would say really, really try to think like any other sector or company. So figure out which funds you want to work for, why do you want to work for them, and why would your addition to the team be relevant, right? So there's three fundamental elements to every single fund, which is the stage they operate from early stage to growth, the sectors or verticals that they focus on, and the last one, the geographies. So figure out exactly what you want, at least on these three categories. The second one is really to understand the size of the ecosystem. The VC ecosystem, 10 funds, if there are 10 funds, 20 funds in most ecosystems, especially in emerging markets, every single fund is going to have something like 4 or 5 people. So you may be talking about an ecosystem of below 100 people, everyone considered. And the last one is really be ready for the long run. Getting into VC is a long ball in a sense that your investments will going to take time to pan out. You'll have to be there for a couple of years, longer than you'd have on a normal job. So do think before you jump in this ship, because it is one of really committing to a specific area for a little bit longer than a typical job would.
Great. And then how about Vishal? You can go next.
So I definitely think that the ecosystem for venture, even over here, even though there are many more funds and opportunities that are opening up, it's definitely getting more competitive over time. I don't think it was as competitive 5 or 6 years ago when there was no venture ecosystem than it is right now, and it's exploding. And so I think the real question is, how do you stand out in the pool of applicants that are all going to have great CVs, come from amazing backgrounds that venture funds are going to be looking at? And one of the sort of like perhaps off beaten path advice I give to people who ask me this question is, how do you demonstrate that you have a genuine interest in this entire sector or ecosystem to stand out? And so one of the ways of demonstrating a genuine interest is by actually being familiar with the asset class of startups. What is the work that you've done around startups? The other way is, and this is low-hanging fruit because very, very few people do this, is how can you write or become a thought leader or an expert in this particular sector to show that you've been developing an interest in the ecosystem over time. And I think it's sort of like things like that. You just want to show proxies for real interest in startups and in venture. And the best way to do it is perhaps these few ways, because, and I don't think anyone is going to tell you otherwise, it's not a very difficult profession to be in. It's really about showing that you have an interest and then getting the opportunity to make something out of it once you've started.
Yeah, great. Creating content and coming up with your own investment. A great way to go. I think Michael can close it off.
I just say the old adage of it's not what you know, it's who you know. So, and it goes to, I think the points that have been made before. We've got a team of 6. Actually, 3 of them interned at us before we hired them. A bunch of our other interns, you know, because as has been mentioned, it's a very small ecosystem, so everybody gets to know everybody else very, very quickly. And it's much easier when you're applying for the job if they've got to know you, they've talked to you, or the associates have. And a lot of time, founders or people, MBAs, go straight to the partners and try and get, you know, coffee with them. The reality is, partners of the fund, if you try and get a meeting with Vishal, you're kind of going to have to wait a few weeks. And I'm not saying it's any different for me or anybody else. The associates are the way to go. You know, the associates are much more, they're trying to build their brand as well. They're trying to build their network. Talk to them, get to know them. They can put you forward. So we're looking at potentially hiring an investment director at our fund. And it's actually come through somebody who was in, the introduction came through one of our associates who'd met her had been introduced to her and been chatting to her for a while and got to know her. So with all of these things, again, that there's probably for every opening now in a VC, there's probably at least 30 or 40 applicants who are very good who are actually applying for it. And to be quite honest, everybody's got an MBA, or they've worked at like Google, or so it becomes an easier decision for us to make if we've actually got to know them. And it could be because you've written blogs. There's a very famous guy who's got very far, and he in the VC world, his name is Harry Stebbings, and he literally started he called it the 20-minute VC, and he went around and he interviewed partners within a VC for 20 minutes, posted it, very early days doing it, got to know every VC that he taught, every partner he talked to, introduced him to 2 other partners. So within the space of 2 years, he got to know everybody, and this is in the London scene, and I think he's now based in the US. And when he joined, he went straight into as a senior associate on a very fast path to move up. So it's little things like that. He got his brand known. People knew he was, but he's well connected, can get deal flow. Somebody we want to get in.
Yeah, that's great advice. And that concludes the session. We're getting a lot of positive comments from the audience here. I think everyone really enjoyed it. And I thank the 3 of you for taking your time out of your day and staying over even longer than we had expected to, and contributing to such a great discussion. So thanks again.
If there's any questions or people that are interested, just tell them to drop any of us a message, or if you want to collate them and then send them to us, sure, we can put something together to help answer, because I know there's been a few popping up which we haven't been able to answer.
Sure, definitely will do. Great. Yeah, thanks so much, and you guys have a good night. Take care.
Thank you.